want to talk about financial analysis and forecasting.
Imagine nikitoka hivi na nyamaza. Sasa ajiongezewe time saa moja. Sasa mwanga serious. Eliza, kala kama moja kierere. Kierere. Wengi wanasema wakipewa time. Parara. Sahi. Nani? Eliza, Elizabeth. Niko nani? Panjiwa. Ex wa huyu. Wangari. Wanani?
Okay, this topic, financial analysis and forecasting, as you see, as two parts. But one of the topic is financial analysis. Financial analysis, or sometimes what we like calling financial statement analysis. It's financial analysis, or some people like talking about financial statement analysis. Part 2 of the topic is financial forecasting. And I think your syllabus is very clear on what aspect of forecasting. Financial forecasting. And your syllabus is very, very clear that we should go through the percentage of sales method, and secondly, preparing of cash budgets, cash budgeting, financial planning and forecasting, financial planning and forecasting, part 2. But your syllabus, that area is very, very wide. Financial planning and forecasting is a very, very wide area, but I think your syllabus is very, very clear that we only need to talk about the percentage of sales method and the cash budgeting. So these are the issues which you guys are expected to appreciate in this topic known as financial analysis and forecasting. Now, part 1 of the topic, financial statement analysis, is an area that I gave you the notes. And I believe you guys are reading through the notes. I think my role is going to be quite simple. It's basically to compress and discuss the information contained in the handout that I gave you. Now, when we talk about financial statements, I know you guys are aware that there are a number of financial statements, but for me, I'm interested in 2 of these statements. One is an income statement. Income statement, or what traditionally you refer to as a profit and loss account. And 2, a statement of financial position. Statement of financial position. Statement of financial position, or what traditionally is referred to as a balance sheet. And what I know, you guys are aware that collectively, these statements are referred to as the final accounts. Is that correct? Is that correct, ladies and gentlemen? These statements are usually collectively referred to as the final accounts. So we are required to do a financial statement analysis. What are we interested in? Now, one thing that I know you guys are aware of is that an income statement, or what we refer to as a profit and loss account, is prepared to summarize the firm's trading results over a period of 1 year. An income statement summarizes the firm's trading results over a period of 1 year. In other words, when you prepare an income statement, you'll be able to tell whether an organization is making profit or whether it's incurring a loss. A statement of financial position, on the other hand, or what traditionally is referred to as a balance sheet, is prepared to summarize the firm's financial position as at a given time. Now, by merely looking at the final accounts, an income statement and a statement of financial position on a face value, you cannot be able to conclude with certainty that the firm's performance has improved or wasn't. I think that's the truth. Yeah, by merely observing an income statement or observing a statement of financial position, it's almost impossible for you to conclude that the company's financial performance or financial position has improved or wasn't over time, because there could be hidden facts that cannot be seen on face value. And that's why we have to interpret these financial statements. We have to go deeper and interpret the elements of the financial statements. One common tool that is used in this interpretation is what we call financial ratios, or what sometimes we simply refer to as ratio analysis. Ratio analysis is a popular tool. Ratio analysis is a popular tool that is used in this kind of analysis. Of course, there are other tools. It's not only ratio analysis that is used in financial analysis. We have other tools like the vertical analysis, we have the horizontal analysis, common size financial statement analysis, and so forth and so on. But ratio analysis is one of these popular. Ratio analysis is one of these popular tools that is used in financial analysis. So I've already said we have ratio analysis. We have the vertical analysis, another tool that can be used, vertical analysis. We may have the horizontal analysis. Horizontal analysis. We may have common size financial statement analysis, common size analysis, and so forth and so on. Of course, when you are doing a vertical analysis, you could convert those financial statements into percentages. But I've indicated that ratio analysis is one of these popular tools that is used in this case. Now, what is ratio? A ratio is defined as an indicated quotient. Financial ratios are defined as an indicated quotient between two mathematical expressions, indicated quotient between two mathematical expressions, which can be expressed as percentage, which can be expressed in shillings, which can be expressed, like now a percentage, you can say A%, shillings, which can be expressed as stated comparison between numbers, maybe A to B, which can be expressed as number of times, maybe A times, or simply a number. An indicated quotient. Mathematically, a quotient is division. This divided by this. This divided by this, multiplied by 100. This divided by this. In shillings. This divided by this, number of times. Quotient, mathematically, is division. So ratios are defined as an indicated quotient between two mathematical expressions expressed in percentage, in shillings, stated comparison between numbers, number of times, or simply a number. Now, when we use financial ratios in financial statement analysis, I've already said that we wish to go deeper into the final accounts to be able to tell the financial progress or otherwise of a company. Is company performance improved? Has company performance worsened over time? So financial ratios helps to be able to go deeper into the final accounts of an organization for us to be able to tell the financial progress or otherwise of a company. And when I talk about financial progress, in this case, there are aspects of performance which we are concerned with. One aspect of performance is profitability. Profitability position of the firm. The other aspect of performance that we can use financial ratios to be able to interpret is liquidity position of the firm. The other aspect of performance that we are interested in is the efficiency position of the firm. Efficiency position of the firm. The other aspect of performance that we are interested in is the coverage position of the firm. The other aspect of performance which we are interested in is the capital structure, analysis of the firm's capital structure. Capital structure position of the firm. Then finally is looking at the firm's equity and the value position using equity ratios. Ladies and gentlemen, I've said that financial ratios provides a framework upon which to investigate the firm's performance on various areas, and I've broken down these aspects of performance into 6. One aspect is profitability, liquidity, efficiency, coverage, capital structure analysis, and equity, or analysis of the equity and the value of the firm. I'm not sure whether in your financial reporting, and I know ratios were introduced to you in financial reporting, whether this classification was done in this manner. Did you classify these ratios in this manner? Profitability ratios, liquidity ratios, efficiency ratios, coverage ratios, capital structure ratios, and equity ratios. Was this classification done in this manner?
We are just familiar with the 2 ratios.
Yes.
We are familiar with the 2 ratios, profitability and liquidity. Yeah.
Okay. Okay. I already gave you a handout on this, but I think I want quickly to summarize. First category of ratios is zinaitwa profitability ratios. Profitability ratios. Now, profitability ratios are those ratios that are applied to investigate the firm's profitability. Has the firm's profitability gone up or firm's profitability gone down? Has profits gone up or profits come down, and why? Normally, profits will go up if the firm sales goes up or costs are reduced. Where there's an increase in sales or reduction in costs, profits can go up. If there's a reduction in sales or an increase in costs, profit will come down. So profitability ratios provides that kind of a framework upon which to be able to have that idea. Now, one of these ratios is known as the gross profit margin. Let me quickly mention them. The gross profit margin, one of the popular profitability ratio in the gross profit margin. This is given by what? You take the firm's gross profit, you go to the income account, pick the gross profit. On the same income account, look for sales times 100. Multiply by 100, that will give you maybe 8%. One of the common profitability ratio is referred to as the gross profit margin, given by gross profit over sales times 100. Of course, the higher the ratio, the higher the profitability. Lower the ratio, the smaller the profitability. Number 2, we have the net profit margin. The other profitability ratio to a net profit margin, which is a ratio of operating profit, earnings before interest and tax, divided by sales times 100. The net profit margin is determined by comparing the firm's operating profit. Earnings before interest and tax is operating profit divided by sales times 100. That will give you maybe B%. Operating profit margin. Now, sometimes it may be condition that determine the after-tax profit margin. See, this conditional now. If we are informed, work out the after-tax profit margin, then you take net profit after tax. You go to the income account, pick net profit after tax, divide by sales times 100. And that will give you the answer. Probably, again, maybe C%. So please take note here. In most of the books, when you go through Pande, you'll find they are saying operating profit over sales times 100. However, if one talks about the after-tax profit margin, then you need to look for profit after tax divided by sales times 100. So this ratio sometimes is controversial, depends on where you are reading, but the popular ratio is operating income over sales times 100. In the absence of any specifications, just take operating profit divided by sales times 100. But if you are asked to find the after-tax profit margin, then you should work it out based on net profit after tax. The other profitability ratio is referred to as return on capital employed. Another popular profitability ratio inaitwa return on capital employed. How well a firm utilizes their capital employed to generate profit. Return on capital employed is equal to capital employed, operating income, earnings before interest and tax, divided by capital employed times 100. If you multiply this, it should give you maybe D%. Return on capital employed tells you how well a firm is utilizing the capital employed to generate operating income. Earnings before interest and tax divided by capital employed times 100. Now, what is this capital employed? Capital employed can be fixed assets plus current assets minus current liabilities. That is capital employed. Or capital employed can be equity capital, equity plus debt plus preference share capital. So it depends. If you're given equity, equity is ordinary share capital plus reserves plus long-term debt plus preference share capital, that is capital employed, long-term capital employed. Equity is long-term owner-supplied capital. Debenture capital is long-term owner-supplied capital or other long-term loans. So debt in this case is debenture capital plus other normal long-term loans plus preference share capital. So it depends. We can look at capital employed from those two perspectives, either fixed assets plus current assets minus current liabilities, fixed assets plus current assets minus current liabilities, or you take the long-term capital employed. If you look at your balance sheet, you can see that when you take this, whatever answer you find here must equal to the finance by section. If you say total assets less current liabilities financed by ordinary share capital plus reserves plus debenture capital plus preference share capital, the debit side should be equal to credit side. So return on capital employed is another popular ratio. The other popular profitability ratio is referred to as return on equity. Return on equity. This ratio tells us how well a firm utilizes equity capital to be able to generate income. Return on equity is equal to earnings attributable to shareholders, earnings attributable to shareholders, earnings which are attributable to shareholders divided by equity capital. Divided by equity capital times 100. That shall give you the answer in percentage. How well a firm utilizes their capital employed to be able, how well a firm utilizes equity to be able to generate net income. Now, please let's take note that earnings attributable to ordinary shareholders is profit after tax minus preference dividend. Earnings attributable to ordinary shareholders, you go to the income statement and look for the profit after tax, remove preference dividend, net income. So earnings attributable to shareholders is what we refer to as net income. Also, ukienda kwa income statement, utatafuta your net income, then divided by equity. Please take note that equity is ordinary share capital plus reserves. Ordinary share capital plus reserves. Whether they are revenue reserves or capital reserves, unachukua yoyote. That gives you return on equity. By the way, some people like calling it return on owner's investment. Return on owner's investment. Equity capital is capital given by the owners. Equity capital is owner's investment. So it's basically an actual return on owner's investment. The other ratio that falls in this class is return on total assets. I want to pick around 6 common ratios in this category. Return on total assets. What sometimes we simply say ROTE, return on total assets. How well a firm utilizes their total assets to generate income. Return on total assets is given by operating profit divided by total assets times 100. That is the formula. You take the operating profit divided by total assets times 100. Now, all these five ratios, if you're doing a trend analysis, comparing performance of the firm this year compared to last year, if the trend is an increase, then you conclude profits has gone up. If the trend is a reduction, then you conclude profits have come down. But there is a sixth ratio, final ratio that I want to mention that falls under this profitability, which is known as the operating ratio, operating expenses ratio. Another profitability ratio is operating expenses ratio. But people like referring to it as operating margin. Na wale wanapenda kuita operating margin, operating expenses ratio, or simply operating margin given by firm's operating expenses. Look at all operating expenses divided by sales times 100. Total operating expenses divided by sales times 100. Now, this ratio tells us, gives us what proportion of sales is consumed by operating expenses. If you work out the ratio and you find X%, for example, what you're simply saying is that X% of sales are consumed by your operating expenses. If then a higher proportion of sales are consumed by your operating expenses, and that will cause reduced profit. If a small proportion of your sales are consumed by operating expenses, then that will tell you increased profits. This is the only profitability ratio where an increase is not good, because an increase in the operating expenses ratio tells you reduced profit. A reduction in the operating expenses ratio tells you there's an increase in profit. So I think in the document that I gave you, I discussed all these ratios, but I felt it's good for us, to be able to summarize that. I want quickly to talk about the other categories. Second category of ratios are liquidity ratios. Now, liquidity, this is working capital. Of course, when you bring in issues of liquidity, this introduces working capital. And when you bring in working capital, these are current assets and current liabilities. Sorry, I didn't go through the topic of working capital. As a colleague, I delegated to help me when I was unwell. But I believe in that topic of working capital, what you have seen is that much of the discussion revolved around current assets and current liabilities. Management of inventory, management of cash, management of debtors, management of creditors, financing of working capital, the aggressive and all that policies, conservative and so forth. Working capital operating cycle, liquidity is a function that entails management of working capital. And anytime that we talk about working capital, then what comes into our mind are current assets and the current liabilities. In my view, I like looking at these as natural partners. Nyumbani kuna zingine siwezi ongea, nyumbani na my younger daughter is here. I should have given an example there. Okay. So it's natural. It's natural. When you look at current assets, quickly current liabilities. Ukiangalia current liabilities, quickly current assets. Now, liquidity is the ability of a firm to meet their current financial obligations as and when they become due. That's liquidity. Firm's ability to be able to take care of their current liabilities as and when they become due by liquidating their current assets. If a firm liquidates its current assets, when I talk about liquidating current assets, is conversion of current assets into liquid cash. Maybe inventory into cash, debtors into cash, cash equivalent into cash. Can a company liquidate their current assets and comfortably take care of their current liabilities and remain with enough working capital? That's the question we are investigating under liquidity. How comfortable is a firm in terms of meeting their current liabilities by liquidating current assets? Can they do so and remain with enough working capital? If so, then the firm's liquidity position is stable. But if firm cannot liquidate their current assets, take care of their current liabilities, and remain with enough working capital, then we say their liquidity position has a problem. And firms that have unstable liquidity are exposed to a risk we refer to as liquidity risk. Now, this investigation is done by the use of one, current ratio, and two, the acid test ratio. Kuna mtu anaweza nisaidia kupata current ratio? Is these two classes mliniambia you have an idea? What is the formula for finding the current ratio? Wenzangu? Nani anaweza nisaidia tafadhali? Mimi hiyo formula imepotea kidogo kwa kichwa.
Current assets over current liabilities.
Thank you, madam. Your name is you?
Regina.
Regina, thank you so much. All current assets divided by current liabilities. Sasa unaenda kwa balance sheet, unatafuta current assets zote. Kwa hiyo statement of financial position, unatafuta current liabilities and you divide. Now, the ratio of current assets to current liabilities is A to B, stated comparison between numbers. Current ratio is expressed as stated comparison between numbers, A to B, 1 to 2, 1.5 to 2, and so forth and so on. But let me say, the ideal current ratio is 2 to 1. Ideal, the optimal ratio. This is what is expected. Okay? The ideal current ratio is 2 to 1. In other words, current assets at all times should be double current liabilities. So if you find the firm's ratio approaching 2 to 1, then you say liquidity position is good. But it's far away from 1, hiyo sio mzuri. Ukipata ratio of 3 to 1, hiyo sio mzuri. Ukipata ratio of 0.5 to 1, hiyo sio mzuri. Now, 3 to 1 could imply overcapitalization. Overcapitalization. Yeah. If you find 0 to 1, you need undercapitalization, or sometimes what we call overtrading. Eh? So the ratio can tell us, is a company overcapitalized? Is a company undercapitalized? Or whether the investment in working capital is optimal. I know my colleague who was assisting me in the topic of working capital management may have told you that the prime objective of managing working capital is to ensure that a firm adopt and maintain an optimal investment in working capital. Optimal stocks, optimal debtors, optimal cash, optimal creditors, optimal accrued expenses, optimal working capital. The ultimate objective of a firm in terms of management of working capital is to ensure that they maintain optimal levels. So if a company's ratio is 2 to 1 or closer to 1, tells you the investment in working capital is optimal. Otherwise, either they are overcapitalized or undercapitalized. Asset test ratio is current assets, all current assets minus stock, divided by current liabilities. The asset test ratio is a ratio which sometimes is known as quick ratio. It's an asset test ratio or quick. Yeah, you know, when we talk about quick current assets. Now, inventory is viewed to be a current asset, which is not a quick asset. The reason is because a firm can take time to convert inventory to cash. So for that reason, stock is not a quick asset. So all other current assets, excluding inventory, which is not a quick asset. So the ideal ratio here of the quick current assets to current liabilities is 1 to 1. The ratio of quick current assets to current liabilities is 1 to 1. That is the ideal position. That is the optimal position. So those two are ratios that investigate that aspect. Now, the third aspect of performance, already I've talked about profitability, I've talked about liquidity. Now I can go to efficiency. The other aspect of performance that can be investigated by the use of financial ratios, number 3 is efficiency. I hope you guys maybe are summarizing these ratios as we discuss. I want to believe that you have your system of summarizing the formulas somewhere. Efficiency ratios, also referred to as the turnover ratios. Some books like talking about turnover ratios, activity ratios. See which term you're used to. Which term are you used to? Which term are you used to, ladies and gentlemen?
Turnover.
Inaitwa turnover, ama unaweza sema activity ratios ama efficiency. Hiyo ni kitu moja eh? Sawa?
Yes.
Sasa ukienda kwa kitabu upate turnover ratios, useme kitabu kingine nasema activity ratios, ingine nasema efficiency. It is the same thing, eh? Efficiency.
What about management?
Is a firm efficiently utilizing their assets to generate sales or not? Now, when we talk about efficiency or turnover is sales, isn't it? Sales, you need a turnover.
Yes.
Yeah. So how well is a firm utilizing, how well are they utilizing their assets to generate sales? Are they efficiently doing so or not? So this investigation is done by the use of efficiency ratios. Now, the first two ratios investigate efficiency in management of stock. Is a company becoming efficient or inefficient in the management of stock? And when I talk about stock, you guys are aware that we have 3 categories of stock: stock of raw materials, stock of work in progress, stock of finished goods. Now, here I'm assuming that this stock of finished goods. When I compute this efficiency ratio, the assumption it is stock of finished goods. I just want to ask a question, ladies and gentlemen. When you acquire stock of finished goods, or assuming you are manufacturing, and you have obtained your stock of finished goods, what are you worried of? Huh? What are you worried at? You have acquired your stock of finished goods, your premises. So when you're doing this analysis, what are you concerned with?
Holding cost.
Huh?
Holding cost.
No. You see, the holding stock. Okay, of course, there are costs associated with the holding that stock. There are costs incurred, of course, like holding costs, stock out. You may have stock cost of obsolescence. You may have opportunity costs, and so forth and so on. Of course, that is an issue of concern. But in terms of financial analysis, agree with you, gentlemen, that that could be an issue. If this inventory were to stay longer in your premises, then you'll end up incurring a lot of those costs. Yeah. But now, in terms of financial analysis, there are two questions we want to ask ourselves as far as inventory is concerned. Number one is how often do you sell your stock? How often are you selling your stock? Two, how long is the firm taking on average to sell their stock? In the context of analysis using financial ratios, those are two questions we are asking ourselves. How often are you selling your stocks? How long? Efficiency in terms of conversion of stock to sales. Are you frequently converting your stock into sales? Are you staying with that stock for longer? Or are you staying with that stock for a shorter time? Yeah, so analysis of stock of finished goods using efficiency ratios is aimed at addressing those two questions. Which stocks, what example of stocks can I give? Stock of beer? Can you allow me to give stock of beer, to use the example of stock of beer? Beer is a finished good, isn't it? Although as with this curve, you're aware beer as the turnover iko chini kidogo, ndio? Ile bars zimefungwa.
Yes.
How often is a firm selling their stock of beer? How long is the firm taking on average to sell their stock of beer? Efficiency in terms of management of stock of finished goods. Kama hizo beer, you know, there are quite a number of brands. Najua nyinyi hamjui kwa sababu mkunywa hizo vitu. The number of brands, kuna those ones which move very fast. Ama mnajua? Umecheka namna gani bwana? Ni kama unajua wewe, naona kama unajua hiyo maneno Umecheka kweli kweli You see, if you look at those brands, they're those ones that move very fast, isn't it? The turnover is very, very high, the stock turnover, isn't it? And those ones which the turnover is very, very high, the firm takes a longer time. The holding period itakuwa kidogo, isn't it?
Yes.
So if like now, there are brands like Tusker, which I know moves very fast. Which other brands? Guinness moves very fast. All soaps does not move very fast. Ile naitwa all soaps, zile chang'aa, wale watu wanakunywa chang'aa, unajua prefer all soaps. Does not move very, very fast. Sindio? You see, I want you to connect and see efficiency. So the higher the stock turnover, the better. Now, the first question, how often is answered by the use of rate of stock turnover? Rate of stock turnover. I think sometimes you simply call it stock turnover without mentioning rate. Some people like using the word stock turnover, or rate of stock turnover. How often, or the frequency of converting stock of finished good to sales? How often are you selling your stock? That's the rate of stock turnover given by cost of sales over average stock. average stock or finished goods. Notice I'm talking about average stock. Yeah? Cost of sales divided by average stock. Number of times, hiyo itakuwa X times. This ratio is expressed is number of times. Naenda kwa statement of financial position, in income statement, unachukua cost of sales, then check for the average stock. Average stock is opening stock of finished goods plus closing stock of finished goods divided by 2. Average. Opening stock plus closing stock over 2. However, in the absence of the opening stock, then we assume that closing stock represents the average. If there is no opening stock, then don't take the average. Just take cost of sales over closing stock. Sawa? Hapo nafikiri tunaelewana?
Yes. Yes.
Kama hakuna opening stock, take cost of sales over closing stock. That closing stock is assumed to be the average. Sawa?
Okay.
Now, the other common mistake people make is to take sales of average stock. Nimeona wanafunzi wakifanya hiyo mistake. It is cost of sales divided by the average stock. So that explains the question, how often, the frequency of selling stock, the number of times stock of finished goods is convertible to sales. So the higher the number of times, the better, isn't it? If the stock turnover is higher, see you Missouri. You are more efficient, isn't it? Kama ni stock of beer unauza na unakuta credits zinaenda unaleta zingine unaendelea kuuza, the turnover is high.
Yes.
My daughter is listening to this story. Now, if the turnover is high, that means the holding period will be smaller, isn't it? The question of how long the stock of finished goods holding period itakuwa kidogo. Kama unauza sana ukae na hiyo stock. Now, how long? This is answered by what we call the stock holding period. Stock holding period. Okay. The stock holding period is the number of days, weeks, or months a firm takes on average to sell stock of finished goods, given by. Now, there are two possible formulas you use here. The first formula, you can interchange those elements. You take average stock of finished goods, average stock of finished goods, divided by cost of sales, times maybe 365 or 2 or 12. Sindio? You interchange these elements here. Hii inakuwa numerator, hiyo inakuwa denominator. Una interchange hizo. Average stock of finished goods divided by cost of sales times 365. And if the examiner tells you assume 360, to me at 360. That period will be in days. If you take average stock of a cost of sales times 52, that will be in weeks. If you take average stock of a cost of sales times 12, the period will be what? In months.
Months.
Means yasema, you multiply 365 times 52 times 12. Means yasema hiyo. Tafadhali, Sometimes kuna mwanafunzi alisema mwalimu alitupatia hii formula. Mimi sijasema you multiply hiyo yote. Depends on what period you want, whether it's in days, weeks, or months. Alternatively, you can take 365 days or 52 weeks or 12 months divided by the rate of stock turnover. Ukitumia hiyo formula, utapata the same answer. If you know the rate of stock turnover, E, then when you come to the period, just take 365 over the rate of stock turnover, period in days, or 52 over the rate of stock turnover, gives you the answer direct in weeks, or 12 divided by the rate of stock turnover. When you are doing, I saw, I was following keenly when Malim is doing the working capital operating cycle. Did you find this formula somewhere? when you're computing the working capital operating cycle? Mulipata mahali?
Yes.
Hii formula hii, si ndio? The working capital operating cycle, eh? Okay, so I've been addressing efficiency in management of stock using those two ratios. Now, the other item of focus is debtors. We have two other ratios that explains efficiency in management of debtors. And again, we go back to our questions. First question, how often? We want to ask ourselves, how often? The second question is how long? How long? Do we guys know debtors? What are debtors?
Let me try.
Yeah?
Yes.
Debtors,
Allow me to try.
Yes, please. Tell us your name.
George.
George, what is your name? Debtors, George.
I think these are people who owe us. Payables.
Correct. These are accounts receivables, isn't it?
Yes.
Account receivables, Yeah, according to George, they owe us. Account receivables, they owe us. We sold goods on credit with them, and therefore they owe us, isn't it? Debtors arise from selling of goods on credit. And when you sell goods on credit, those guys you have sold goods to owes us. I think George is very, very correct. Now, once you have sold these goods on credit, then one thing that you are worried of, how often will they pay? How long will those people who owe us pay? How long do they take on average? How often do we receive money from debtors? That is explained by a third ratio under efficiency we call debtors turnover. So, debtors turnover. How frequent are we getting money from debtors? The number of times debtors are convertible into cash is debtors turnover, given by credit sales. Credit sales over average debtors. Are we there, ladies and gentlemen?
Yes.
Yeah. Debtors arise from selling of goods on credit. So you take credit sales divided by average debtors. Opening debtors plus closing debtors over 2 is the average. Debtors, of course, this ratio is given as number of times. Debtors turnover is expressed as number of times. Look at the credit sales, take the average of the debtors, and the answer is number of times. Number of times debtors are converted into cash. How frequent we are receiving money from those people who owe us. If we are receiving money more frequently, if you are doing a comparative of 2 different periods, this year compared to last year, and you find the ratio is going up, then that's okay, because we are frequently getting money from debtors. That is the question, how often? How long do we take on average to receive money from debtors? That is explained by a ratio we refer to as the average collection period. Average debt collection period. Anybody anaweza nisaidia hiyo formula? Hii mlifanya when you're doing the working capital operating cycle. Anybody who can be kind enough, please, to give me this formula now? Average collection period is given by what? Angela.
Average debtors over credit sales.
Average debtors divided by
Credit sales.
Credit sales.
365.
Please tell us your name. What's your name? Kindly tell us your name. Whoever has given us this formula. What's your name? Tuambie jina. Umetupatia formula mzuri, nataka kutupatia jina. Sure.
Wendwa.
Mwendo, you have given us a correct formula. Utaki tujue sasa yule ametupatia hii formula mzuri namna hii. Yes, Mwendo, that is correct. Average debtors divided by credit sales. And you notice I've interchanged again these elements. Have you noticed? Debtors turnover is credit sales of average debtors. But if you interchange those elements, now you talk about average debtors over credit sales. That is one formula. The other alternative formula for finding the average collection period is that average collection period. Oh, sorry. Let me see. I made a mistake. Times 365. Sorry.
365, not 100.
Times 365, 52 or 12. Eh? Hapa mjaona nimefanya mistake. Ninyi mjaona nimefanya mistake. Yeah,
No.
average debtors divided by credit sales times 365 or 52 or what? 12. So that is the period in days, weeks, or months. When you come down here, you'll say 365, 52 or 12, and you divide by the debtors turnover. You guys did notice I've done a mistake? What are you contemplating? Eh? Yeah, so the average debtors over credit sales, you can take times 365 or 52 or 12, and that gives you the period in days, weeks, or months. Or simply, you take 365, 52, 12, divided by the debtors turnover. So if you use this formula or apply that formula, I think you should be able to find the same thing. Now, these four formulas explains efficiency in management. Remember, I'm going through efficiency ratios, those who have just joined. So one of the items we have been focusing is stock, rate of stock turnover, and the stock holding period. When you come to debtors, debtors turnover, and the average collection period. The third item that we can investigate efficiency is creditors. Now, creditors arise from credit purchases. I hope you guys are familiar with that. Credit purchases. If a firm were to buy items on credit, that gives rise to credit purchases. And we need to ask ourselves, how often are we paying our suppliers? Since we are buying goods on credit, how often are we paying our suppliers? How long are we taking on average to pay our suppliers? Now, the question of how often can be explained by the fifth ratio in this class, referred to as creditors turnover. Creditors turnover. How frequent is the firm paying their suppliers? The number of times a firm is paying their suppliers. In credit purchases divided by, you'll take credit purchases divided by average creditors. The number of times a firm pays their suppliers. Frequency of paying suppliers is credit purchases divided by average creditors. That frequency, let me assume, is X times. X times. Of course, when I talk about average, that means opening creditors plus closing creditors over 2. That is the average. But in the absence of the opening creditors and closing creditors are taken as the average. Now, the sixth ratio explains how long a firm will take on average to pay their suppliers. So how long does a firm take on average? That is the creditors payment period. Creditors payment period. How long a firm takes on average to pay their suppliers. So here you can interchange these formulas. You can say average creditors. Average creditors over credit purchases times maybe 365 or 2 or 12. But sometimes examiners can restrict you to 360 days. If it does so, or it can restrict you to 50 weeks. If it does so, go by what the examiner said. Alternatively, you can take 365 days, 52 weeks, or 12 months, divided by creditors turnover. I don't know whether you guys can see these formulas in the handout. Je, hizi formulas ziko hapa kweli? Unaziona? Hizo zote?
Yes.
Yeah, so the creditors payment period, you can use the first formula or you can use the second formula. We have gone up to the sixth ratio. Under efficiency, remember we began with inventory, and I said there's a rate of stock turnover, the stock holding periods. The other item that we are concerned about efficiency are the debtors. I talked about the debtors turnover and the average collection period. I brought in creditors, efficiency in management of creditors. Mmeona hapo nimeongea mambo ya creditors turnover and the creditors payment period. The seventh ratio in this class of efficiency is fixed assets turnover. Fixed assets turnover. Efficiency in utilizing efficiency or inefficiency in utilizing fixed assets to generate turnover. Is a company becoming efficient or inefficient in utilizing their non-current assets to generate turnover? Now that question can be answered by the use of what we call the fixed assets turnover. Sales divided by the total fixed assets at their net book value. This gives us X times. You go to the income statement, pick the sales, go to the statement of financial position, pick the total fixed assets and compare number of times. So if the ratio is going up, that tells us that a firm is efficiently utilizing their fixed assets to generate sales. If the ratio is coming down, then tells us that's a sign of inefficiency. Total assets turnover. How well is a firm utilizing their total assets to generate sales? Given by sales divided by total assets. And when we talk about total assets, it's fixed assets at the net book value plus current assets. That shall give us X times. So total assets turnover, you take all sales divided by total assets. Number of times total assets contribute to sales. Finally, there is a turnover of capital employed. I'm not saying these are the only ones, because I know you guys do a lot of reading. One thing I know about our students, they do a lot of reading. I know that there could be other ratios you have come across. Turnover of capital employed is sales over capital employed. How well a firm is utilizing their capital employed to generate sales, X times. Yeah. How well a firm is utilizing their capital employed to generate sales. Capital employed, hiyo niliongea mambo yake kitambo sana when I was talking about profitability ratios. If you remember, I talked about it here. Capital employed, hapa. Yeah, so I talked about it there. How to arrive at the capital employed. So when you go to the statement of financial position, you should be able to find that capital employed and establish how well the firm utilizes their capital employed to generate sales. One thing that I want you to take note, please, are units. Tafadhali, make sure that these ratios are expressed in correct units. Now, quickly, because I want to summarize all of them, we have so far talked about three categories of ratios: profitability, liquidity, efficiency. The fourth category of ratios explains the coverage ratios. Coverage ratios. Those ratios naita coverage ratios. Yeah, the number of times interest and dividend are covered by earnings. The number of times interest and dividend are covered by earnings. The number of times the firm's interest and dividend are covered by earnings. I wanted to ask a small question here. Do you think there is a common characteristic? What common characteristics is there between interest and dividends? Anybody who can see a common characteristics? Anybody? Or let me ask the question differently. When does a company incur interest? What gives rise to incurring interest?
Profit.
Why will a company incur interest? Profit, really.
Loans and
Loans and
debts.
If you go for a debt, if you go for a loan, isn't it?
Yes.
Yes.
Why will a company pay dividends? If they raise money through the issue of ordinary shares or preference shares.
Yes.
Now, that loan and raising of money is basically financing. Company, both of these, the financing cost. Did I talk about this when I talked about leverage in class? Remember, I talked about leverage, operating leverage, financial leverage, and I said these are financing costs, isn't it?
Yes.
Interest and dividends are financing costs. So we are concerned when you do this analysis, how often or the number of times interest and dividend is covered by earnings. Now, this is explained by ratios we call the coverage ratios. Coverage ratios. These ratios ni gani? One is interest cover. Interest cover. Na hiyo ingine inaitwa dividend cover. Dividend cover. And by the way, if I were to be very specific, then I'll talk about preference dividend cover. Preference dividend cover. Then ordinary dividend cover. Although in an exam, in on exams, examiners don't specify. We'll tell you dividend cover. Now, when they say dividend cover without any specification, refers to the ordinary dividend cover. Sasa ukienda kwa mtihani, mtu akwambie work out dividend cover, anataka utafute ordinary dividend cover. But specifically, we have the preference dividend cover and we have the ordinary dividend cover. So how do we arrive at the interest cover? This is given by operating profit over interest. Interest cover is operating profit over interest, X times. Now, there is a way for you to remember. You don't have to cram this. You know that interest is payable out of the operating income. Sindio, when you go to the income statement, once you have established earnings before interest and tax, you deduct interest, isn't it?
Yes.
Then from there, you deduct tax. Then from there, you deduct preference dividend. Sinona. So the easier way to remember is that this interest is covered by what? It's covered by
profit. Then.
In other words, interest is payable out of
Profit.
You understand it that way, so you don't cram. Sasa mkiendelea ukram, hizi ratios zote utakram kweli umalize. Interest is payable out of what? The operating profit. That means interest is covered by the operating profit. So number of times this interest is covered by. Now let me ask a question. Preference dividend is payable out of which profit? Preference dividend is payable out of which profit? When you start appropriating this preference dividend, is payable out of which profit? Profit after tax?
Yes. Yes.
It is payable out of profit after tax. So
Yeah.
you'll take profit after tax over reference dividend. Profit after tax divided by preference dividend. That is X times, again, number of times. So please understand that preference dividend is payable out of profit after tax. That means preference dividend is covered by profit after tax. So preference dividend cover is profit after tax over preference. I think this is one ratio that examiners have forgotten to set. It has never been set. This one, I believe, those who set, so, yeah. Now, ordinary dividend is payable out of which profit? Ordinary dividend is financed out of which profit?
Out of profit after tax and preference dividends.
Minus preference dividend, isn't it?
Yes. Yes.
Yeah. So divided by ordinary dividend. Hiyo itakuwa ngumu kukumbuka namna hiyo kweli? Hiyo itakuwa ngumu kukumbuka hivyo kweli? Sasa watu wengine ataenda kae the whole day. Interest cover, operating profit over interest, operating profit over interest, operating profit. Haya, rudi chini. Preference dividend cover, profit after tax over preferred dividend. Unarudia mara 10 ndio ishike. Ordinary dividend cover, sasa hii yote utafanya hii ratio yote mpaka lini? Okay, no, I'm not referring to you, na watu wanafanya hivyo lakini sio nyinyi. I know you guys, mfanyanga namna hiyo. But there's also an alternative formula for establishing the ordinary dividend cover, earnings per share divided by dividend per share. So, in the last category of ratios, I'm going to talk about these two equity ratios. But for now, please just take note of that you can work out an ordinary dividend cover by taking profit after tax less preference dividend divided by ordinary dividend or EPS over DPS. Or one thing you can observe quickly, if you take profit after tax less preference dividend divided by the number of ordinary shares in issue, that gives you what? Earnings per share. Profit after tax less preference dividend divided by the number of issue, hiyo ni earnings per share. Ukichukua total dividend divided by the number of ordinary shares in issue is the dividend per share. I hope you're seeing the logic. Those number of shares is a constant. Sasa hiyo tumeenda mpaka class number what? Of ratios, number 4. Please allow me to go to the 5th class. We have 2 more. Please allow me to summarize this. Muweze kuzielewa hizo ratios in case kuja kwa mtihani. Msiseme huyu mwalimu alituuza. So I thank God I'm okay. So now that Mungu amenisaidia, wacha tusaidiane sasa muende kufanya mtihani. Sasa kama Mungu amenisaidia na watu wamekuwa wakikufa, sio hiyo ni dalili. Hiyo ni it's a miracle, isn't it?
Yes.
It's a miracle. By the way, one of you is going to pray for us to tukimaliza class. It's a miracle to be alive when you hear people are dying right, left, and center. Mungu amekusaidia. That's a miracle I've seen. The 5th category of ratios are the capital structure ratios. And I hope you guys are taking care of yourselves also. Please take care of yourselves. I used to make some jokes in class. Your wanafunzi hata your boyfriend don't hug her. Don't hug him. Girlfriend don't hug her. Sasa mimi sikujua hizo jokes nilikuwa nafanya class, mimi ndio ndakuja kupata shida. Please don't hug them. Suspend all debts with your boyfriends and girlfriends for the time being. Sasa, you're still meeting them.
Okay.
Huh? You're still meeting them,
We are single.
Yes.
Boyfriends and girlfriends. Tafadhali wachana now. You focus on your exams. Wachana hiyo maneno. Hii corona inaweza kupata mahali eh. Haya. Wacha turudi kwa hizi ratios naitwa capital structure. I'm not praying anyway. I don't want to issue that. Now, remember in the topic of cost of capital, I talked about capital structure. Remember the first thing I emphasized on is capital structure. And I told you that capital structure is the mix of what? It's the mix of the various long-term funds. The mix of the various long-term funds employed by a company in financing these assets. And these long-term funds, we said, are which ones? Equity, capital. And when you come to equity capital, I told you it is ordinary share capital and reserves. Equity is ordinary share capital and reserves. Sindio? Sindio? Ama mmesahau?
Yes.
Mmeshasahau hiyo eh?
Yes.
No.
Unajua.
Kwani mmesahau haraka na magari?
Hapana.
Huh?
Hatujasahau.
Equity is ordinary share capital and reserves. Sindio?
Yes.
One of the components. The other component of capital structure ni gani? Venture capital. Or other normal long-term loans. The other component of capital structure is preference share capital. Sindio?
Yes.
Hebu wacha turudi nyuma kidogo. Equity capital is owner supplied capital. Sindio? Ordinary share capital and reserves. This is owner supplied capital. Hizi zingine zote ni non-owner supplied. So mnakumbuka when I was going through sources of business finance,
Yes.
Huh?
Yes.
Now, when we do a financial analysis and we are investigating the firm's capital structure, then the question we are asking ourselves, to what extent are firms' assets financed by owners? This is owner supply. Equity is owner supply. Hizi zingine non-supplied. So to what extent are firms' assets financed by, or rather, let me put it this way. Is a company using more of owner supply and less of the non-owner supplied in the current year compared to previous years? Or are they using more of the non-owner supplied and less of owner supplied in the current year compared to previous years? You see, that's an aspect then we want to investigate. When you're doing a financial analysis, but the use of the capital structure ratios, that's an issue that we want to ask ourselves. How are firms' assets financed? Are they relying more of equity and less of debt and preference share capital? Or is a company relying on more of debt and preference share capital and less of equity? Now, this can be answered by the use of the capital structure ratios. And one of the popular capital structure ratio is known as the gearing ratio. Mshaisikia mambo ya gearing? Gearing. Mnaita gearing ama gearing? I think some people like using the word capital gearing. Mnaita gearing ama gearing?
Gearing ratio.
Gearing. Now, this is one ratio where people make mistakes. Gearing is the proportion of long-term funds financed by non-owners. Gearing is the proportion of long-term funds financed by non-owners. As we grew hapa nyuma, in equity. See in equity, ordinary share capital and reserves. The venture capital, what I need D for long-term debt. Preference share capital, let me call it E. D. Preference share capital, let me call it P. So what becomes the total long-term capital? Hiyo ni E plus D plus P. Si ni kweli? equity capital plus debenture capital plus preference share capital is total long-term capital. Eh? Gearing is the proportion of non-owner, supplied funds financed by the non-owners. So if you take D plus P is the total non-owner supplied funds divided by the total. So it's a part of your proportion. So what I'm trying to tell you, capital gearing is fixed return capital. If you wish, you can say, I think that's a formula I've used in my handout. Fixed return capital over the total long-term capital. Hii handout nilifanya kitambo, but I think that's what I used. Is that correct? Is that the formula I've used in the handout?
No,
Imesema nini?
over equity capital.
Wewe angalia mzuri bwana. Gearing. Hebu angalia mzuri tafadhali eh?
Yeah.
Gearing ama wewe unasema the ratio of debt to equity.
Gearing ratio equals to fixed return capital over equity capital.
That's a mistake. Fixed return capital over total long-term capital. Imesema equity in the handout.
Yeah.
Tafadhali corrected. Fixed return capital over total long-term capital. Kama nimesema equity, correct it. Fixed return capital divided by total long-term capital. In this case, maybe the venture capital plus preference share capital over the total is the venture capital plus preference share capital plus equity. If that is the error that I've done, I don't have the handout with me, so CG, what is in the handout? But if I said fixed return capital divided by equity, that is wrong. It is fixed return capital over total long-term capital. This fixed return capital is the venture capital, preference share capital, divided by the total long-term capital. You're gearing, eh? So I hope you guys have corrected that mistake, eh? Have you?
Yes.
Correct that mistake. Yeah, because gearing is the proportion of this long-term capital financed by the non-owners. The venture capital and preference share capital, both of them are fixed return capital. Now, that's a popular ratio, but we have also the ratio of debt to equity. Debt to equity. The other capital structure ratio is a ratio of debt. And the many time, when the examiner talks about the debt without specification, when the examiner talks about debt to equity without specifying, this is long-term. It's referring to the long-term debt. Many times, when they say that, they're assuming long-term debt. But the other shortcoming of this ratio is that it disregards preference share capital. You know, when you say compute the ratio of debt to equity, people are assuming we don't have preference share capital in the firm capital structure, which is not realistic. And more often, that is an aspect which is ignored. But if you have preference share capital in the firm's capital structure, then take that as preference share capital divided by equity. Sasa hii ndio divide by equity, eh? Kama hakuna preference share capital, chukua long-term debt divided by equity. And you can find a number, maybe A, or you can express it as A to B. This one you have a leeway. You know, what I'm trying to tell you, ladies and gentlemen, assuming the venture capital in the firm's capital structure is 2 million. Preference share capital in the firm's capital structure is 1 million. Equity in the firm's capital structure is 10 million. Hiyo itakuwa ngapi? Assuming the venture capital is 2 million. Preference share capital is 1 million. Equity is 10 million. Hiyo inakupatia ngapi? 3 million divided by 10 is what? 0.3. Sindio?
Yes.
So some people can work it, they stop there. But suppose you said 0.3 to 1. Is it the same thing as saying 3 to 10? 3 to 10? Si kweli? A to B, 3 to 10, eh? Or simply, you can say 0.3 to 1, eh? You understanding my point, eh? So sometimes you can stop here at 0.3, ama useme 0.3 to 1 or 3 to 10. Hii kai nzuri sana. You prefer, I think that is okay. And if you check, these are the items that we have here, isn't it? Is it possible to get the gearing? Is it possible? Compute the gearing? Suppose the venture capital is 2 million, preference share capital is 1 million, equity is 10 million. What becomes the gearing? Fixed return capital, hapa ni 2 million plus 1 million. Total long-term debt capital is 2 million plus 1 million plus 10 million, eh? Sindio? Hiyo gearing itakuwa ngapi? Ukisema hapa, venture capital is 2 million, preference share capital is 1 million, the total is 2 million plus 1 million plus 10. Gearing ngapi? Times 100.
23.07.
23.07. Is anybody who can interpret for us this 23.07? What is it telling us? Anybody who can interpret for us this? What's gearing? Proportion of non-owner supplied long-term funds financed by the non-owners. So what we are saying is that if you look at the company's capital structure, long-term capital, 23% of the company's long-term capital is non-owner supplied, meaning the balance, 76.93% is owner supplied. Eh? If non-owners are financing a company to about 23%, it means 77% is owner supplied. Eh? Now, from this ratio here, you can even work out the gearing again. Kiangalia mzuri. If the ratio of long-term debt to equity is 3 to 10, what proportion is gearing? Gearing is 3 divided by 13 times 100. If long-term debt to equity is 3 to 10, then what proportion is this? Proportion of the non-owner supplied is 3 divided by 13 times 100, which is how much? Does it again come to 23%?
Yes.
Yes. So from this ratio, you see, now let me clarify this. I've seen errors in most of the books you are reading. One of the errors I've seen in the books you are reading, or most of these revision guides which are done by quacks. You know, there are a lot of quacks out there who have done a lot of revision guides. I don't want to indicate anybody. Those revision guides are helping you a lot. But please take note that some of those guides are done by quacks, or some of those books are done by people who have subcontracted the work to some people, answer questions for them, and come up with revision guides which they become their work. You mean a common mistake? Hearing people saying debt over equity times 100. Hiyo nimeona mzuri sana. Kama hii sasa mtu angesema 30%.
Excuse me, sir.
Yes. Yes. Yes, you are excused. You are excused. Eh? So please don't say 3 million divided by 10 million times 100. Tafadhali, gearing is not. Unasikia what I'm telling you? Hapa watu wengine wataenda wanasema gearing kama hii sasa angesema 2 plus 1 divided by 10 times 100, 30%. That is not correct. But from the ratio of debt to equity, you can work backward and find the gearing. The third ratio, capital structure ratio, is total debt to equity. Total debt to equity. You see now, is total debt. That means long-term debt or current liabilities plus long-term liabilities over equity. Total debt to equity. Total debt means short-term debt, which are the current liabilities. Long-term. Now, long-term, this is the debenture capital again plus preference share. Debenture capital plus other long-term loans or long-term liabilities, including preference share capital. You add current liabilities. Total debt to equity. That means long-term liabilities, including preference share capital plus current liability divided by equity. Here, the ratio of total debt to equity. The other capital structure ratio is referred to as debt ratio. You know, these ratios, if you're not careful, looks like they are almost similar. Debt ratio is total liabilities over total assets times. These capital structure ratios, wenzangu, please take a lot of care because they can be very confusing. Eh? I've said total debt to equity, pick current liabilities, or long-term liabilities, including preference share capital divided by equity. Then we have what we call a debt ratio. You pick total liabilities, long-term liabilities plus current liabilities. Yeah, so long-term liabilities divided by total assets. Total assets, of course, fixed assets plus current assets. So total liabilities divided by total assets is 100. Hiyo inatupatia ratio tunaita debt ratio. So these are common capital structure ratios: the capital gearing ratio, the debt to equity ratio, long-term debt to equity, and debt ratio. Now, kwa sababu najua kuna chakula imepikwa na nataka kukula, please allow me to explain the final category. Or do you need some break? Equity ratios. Do you need some small break? Ama tuendelea tu?
Tuendelee.
Let's finish.
The final category of ratios naitwa equity. Eh? So far, nimewapatia ratios ngapi?
5.
Hizo 5 categories ziko kama ratio ngapi? The total? Karibu 30, eh?
Yes, a lot.
Sasa examiner ataleta hiyo yote 30 kweli?
No.
Na zile ataleta utajua kweli? So the only way out is to appreciate and understand them. Eh? Have those formulas in your fingertips. Once you have the formulas, computation is not a big deal. Now, we have equity ratios, the final category of ratios. Now, equity ratios are measures of shareholders' returns, measures of the shareholders' returns, and value equity shares. So when we do a financial analysis using the equity ratios, what we basically focus on are looking at the returns on investment in equity returns on investment in equity and the value of equity. So it is equity, is equity. Yeah, so returns from investment in equity. So when I talk about returns, these are returns from investment in equity. These returns are which ones? What returns arise from investment in equity shares? One of the popular returns is earning per share. Isn't it? Earning per share. If you invest in one ordinary share, what return does that earn in a year? Earning per share is equal to profit after tax minus reference dividend. Profit after tax, deduct preference dividend over the number of issued ordinary shares. This is given in shillings. The answer is in shillings. Earning per share is expressed in shillings. Earning per share should not be given in percentage or a number of times. This is shillings. This is earnings attributable to the shareholders. If you take profit after tax minus preference dividend, are earnings attributable ordinary shareholders divided by the number of issued. I know you guys know that there's a difference between issued share capital and authorized share capital, isn't it? Are you aware there's a difference between the issued and authorized share capital? So number of shares issued. If some shares are not issued, please don't capture those shares here. Where the authorized share capital is not equal to issued share capital, then whatever the firm is authorized to issue, they have not issued. You cannot capture those in the working. So if in a statement of financial position, you're given the authorized share capital, and again, you're given the issued share capital, use issued, not authorized. So the return earned from investment in one share. Very, very similar to this is what we call earnings yield. Earnings yield. In short, I like calling it EY. Another ratio, earnings yield. I've said that earning per share is a return that a shareholder earns from investment in one share. It's a return. Shillings 3 or shillings 5 is a return from investing in a share. Earnings yield is a return from each shilling invested in ordinary shares. Earnings yield is a return earned from 1 shilling invested in ordinary shares. Earning per share divided by market price per share times earning. Earnings yield is expressed as a percentage. So you have to know the earning per share divided by the market price per share times 100. For example, if this was 10%, assuming the earnings yield is 10%, that means that 1 shilling you have invested in ordinary shares will give you a return of 10 cents. Take 10% of 1 shilling invested in ordinary shares, that shall give you shilling 0.1, which is basically 10 cents. A return per shilling invested in ordinary shares. So when you compare earning per share and the market price per share and it gives you 10%, basically what you're saying, the 10% of a shilling is a return of 0.1 or 10 cents. 1 shilling you have put in ordinary shares has earned 10 cents. Number 3 is dividend per share. Dividend per share. Whatever investment you have done in ordinary shares, what return will shareholders enjoy in the form of dividends from each share invested? Your share has earned so much. Out of what your share has earned, how much is given to you in the form of dividends? This is total dividend. proposed and paid. Total ordinary dividend. Nimeongea sana mpaka sikia sasa napata kupata shida, sijapona kabisa. Total ordinary dividend divided by the number of issued ordinary shares. Sasa hiyo ukichukua hiyo inakupatia this is in shillings. Total dividend proposed or paid. Total dividend proposed and paid. Or total dividend that has been proposed and has not been paid. Divided by the number of shares. Like now, if your earning per share is, for example, was 2 shillings, management can decide from those earnings to give you 1 shilling as dividends. What happens to the other shilling? I think I discussed this when I was going through dividend policy. If your shares earned 2 shillings, and management decides from the 2 shillings your shares earned, they will only give you 1 shilling as dividend. The other 1 shilling goes where? It's retained, isn't it?
Yes.
If your share has earned 2 shillings and the management decide to give you 1 shilling, that means the payout is what? The dividend payout? What's the dividend payout? Your share has earned 2 shillings and the management has decided to give you 1 shilling as dividend. So what's the payout here? Do you remember one of the dividend policies we talked in class, dividend payout policy, constant payout? So you can again say the dividend per share is payout ratio, the payout ratio times earning per share. Unakumbuka I talked about these issues in the class. If a firm adopts a constant dividend payout, kuna wazimu imetokea kwa hii laptop yangu, sielewi wazimu imetoka wapi, bear with me. Hiyo wazimu yote sijui imetoka wapi, hiyo mnaona hapo. So obviously if you check keenly, it's 50% payout. 50%, eh? To me, hiyo example nilikuwa nimewapatia. Earning per share is 2 shillings. So if you take 50% of 2 is 1 shilling, eh? That means the payout is 50%, 50% of 2. So the computation of dividend per share, you can work it out using this, or you may use that formula. Number 4, dividend yield. Another equity ratio inaitwa dividend yield. Hiyo unachukua dividend per share over market price of each share times 100. Dividend yield is expressed as percentage. 1 shilling you have put in ordinary shares. What dividend are you earning from a shilling that you have put in ordinary shares? Net dividend yield. Return earned a form of dividend from each shilling invested in shares. The 5th ratio in this class, net price earning ratio. How do we arrive at the price earning ratio? It's better that he told you. Sasa huyu anafungulia hiyo radio yake, anafikiria sisi hatutaki kuona news. Yeah, anaona tumefurahia sana kukaa hapa, sisi hatutaki kwenda kusikiza hizo vitu anatuwekea. So price earning ratio is market price per share divided by earning per share. Maybe number of times again. This one I think we have interacted with it several times when I was going through valuation models using the price earning ratio basis. So market price per share divided by earning per share times 100, X times. Now, if you interchange these 2 elements and you say earning per share over market price per share, this takes you back to what I was calling dividend yield. So the earnings yield. Kuna kitu nimeongea hapa inaitwa earnings yield. Yo. Earning per share over market price per share times 100. I'm saying price earning ratio is market price per share over earning per share. If you interchange those elements, that what you end up establishing is referred to as the earnings yield. The sixth ratio in this class is book value per share. When I was going through valuation models, I told you that it's possible to value a share using book values. It's possible to value a share using book values. Which value we establish is referred to as the book value per share using a valuation model known as net asset basis. Kama mnakumbuka, I think I talked about that. Those models of valuing equity shares. One of the models of valuing equity shares in a net asset basis, where you establish the book value per share. I said this one you can take fixed assets, total, current assets. Of course, these are the net book value. Fixed assets are the net book value plus current assets, minus current liabilities, minus long-term liabilities, minus preference share capital over the number of issued shares. Hii formula mnaikumbuka? Under valuation of equity, I think I explained this. Yeah, all fixed assets are the net book value plus current assets minus current liabilities minus all long-term liabilities less preference share capital over the number of issued shares. That one will give you the book value per share in shillings. Finally, was I request you guys, Madam Tavute Chakula Mukule, market value to book value ratio. Market value to book value ratio. In relation about that. That's what? Market value to book value ratio. Suppose now you compare the market price per share divided by book value per share. This is merely a number, maybe A. So market price per share over the book value per share is a ratio of the market value book value ratio. Okay, one thing I know is that I've explained these ratios. For those of us who have been going through the document that I gave you, I want to believe you have seen all this information. And when we do a financial analysis as a wind-up, all these ratios can be worked out to investigate those aspects of performance. So financial ratios can be used to evaluate profitability position using profitability ratios. Financial ratios can be applied to evaluate the liquidity position of the firm by the use of liquidity ratios, to evaluate the efficiency position, that is whether a firm is efficiently utilizing their assets to generate revenue or not. The number of times dividend or interest is covered by earnings by the use of the coverage ratios. Financial ratios can be applied to investigate capital structure, that is the composition of the various elements in the firm's capital structure, and whether a firm is using more of owner supplied and less of the non-owner supplied in the current year compared to previous years or the vice versa. We can use financial ratios to compare returns from investment in equity shares and also value of those equity shares. We can use financial ratios to carry out a trend analysis in each of those aspects. Trend analysis is an analysis which involves comparing the company's financial performance over time. If you want to compare the company financial performance this year compared to last year, then you can do a trend analysis. Look at the profitability ratios and compare various periods. Liquidity, compare various periods of time. Assets, efficiency ratios, this year compared to last year. If you wish to evaluate the performance of a company this year compared to last year, in each of these 6 categories of ratios, then you will be carrying out what we call a trend analysis. trend analysis, sometimes also referred to as cross-sectional analysis. The final application of these ratios is to carry out what we call a cross-sectional analysis or industrial analysis. Financial ratios can be applied to carry out a cross-sectional analysis, or sometimes what we refer to as industrial analysis. This involves comparing the company financial performance with the industrial average performance. So sometimes examiners can give you the industrial average ratios, a few ratios, and you're required to work out the company ratios and compare with the industry average. That analysis, which you are required to do in that case, is referred to as industrial analysis, or what we refer to as cross-sectional analysis. So you can compare the company profitability position with the industry average. You can compare the company liquidity position with the industry average. You can compare the company efficiency position with the industry average. And that is what we refer to as a cross-sectional analysis. Now, finally, of course, a number of limitations are explained in the handout. Even though ratios are very, very important in financial analysis, they suffer from a number of limitations. Of course, one common limitation is that they don't take into account the aspect of the change in value. When using financial ratios to do a financial analysis, we don't incorporate the aspect of the change in value money. That's one shortcoming. Number two, it's not possible to do an industrial analysis where a company is the only company in the industry. In other words, a monopoly. If a firm is a monopoly, then it's not possible to carry out industrial analysis using financial ratios. Three, firms in the same industry are not the same. Firms in the same industry differ in various ways. They differ in policies adopted. They differ in methods of valuation stock. They differ in terms of their levels of diversification and size. And therefore, it becomes very, very hard to use financial ratios to compare performance of those firms. Firms in the same industry are not the same. They're different in various ways. And that makes it very hard. That makes it very, very hard to be able to use financial ratios to evaluate the performance of those firms. The other shortcoming of financial ratios is that financial ratios can only be applied to evaluate quantitative aspects of performance, what can be quantified. Financial ratios cannot evaluate qualitative aspects of performance. It may be the quality of management, the quality of employees, the quality of products, or the quality of services. You know, how a firm relates with their stakeholders, how a company relates with customers, how they relate with suppliers. You know, that's an aspect of performance you can evaluate. But financial ratios cannot evaluate qualitative aspects. And let me say this, financial ratios are short-term planning tools. In other words, they are important short-term planning tools and may not be very useful for long-term planning purposes. So these are short-term planning tools and may not be very useful for long. And finally, financial ratios only provide a clue and point to areas of weakness requiring further investigation. Financial ratios don't form the basis of final conclusions. They only provide a clue and point out to areas of weakness requiring further investigation. What I mean is this: if you call your girlfriend and you call your boyfriend and you find they're not responding, you don't conclude that they don't want you. Oh. Yeah. It's a clue that points to some problem that requires further investigation. You understand my point? Yeah, so financial ratios only point out to areas of weakness or areas of strength that require further investigation. They don't form the basis of final conclusions. I want to believe that this discussion I've given you is useful. Has it been useful? I've summarized all the ratios in your handout. Si kweli? Now, out of these ratios, siwache tumalize hii mkutano ndio weke hizo vitu zako. Siwache tumalize mkutano, ukufungulie wewe, angalie news, angalie mambo yako. Mimi namaliza mkutano in a short while. So those ratios are many, about 35 or so. What I know is that examiners cannot set all of them. They might pick only a few and test. So my appeal to you, please go through the past papers and check a few questions which you can answer. Let me finish by saying this. In this topic, we are expected to talk about financial forecasting. And as I said earlier, there are two methods which we'll talk about. But I'm going to talk about one, financial forecasting. I'm going to discuss one next time, percentage of sales method. Cash budgets are not new. And I'm going to advise that you guys go read your cash budgeting. Preparing of cash budgets, I know this one you've done in management accounting. In budgeting. Budgeting inafanyiwa mnafanya wapi? For management accounting. Is there a topic like budgeting in management accounting? It is there.
Yes,
so what I know, this one, please revise. This one you have done. I'm not going to really bother with preparing of cash budgets. Let me make a humble request, but please revise your preparation of cash budgets. But I'm going to take you through next class the percentage of sales method. Okay. I decided to request for this class within a short period because one, the other Mwalimu friend of mine is going to take you through working capital management tomorrow evening. Kinutia told me he's going to take you through working capital management. And when I discovered your financial reporting, Mwalimu will not come. So I chose to convene a meeting within a very short time. I don't know whether I inconvenienced some of you. If I did, I apologize. Coming for asking for a meeting for a very short time. But I hope I've been able to summarize those issues, and please look at your past paper and answer. There's a question where you are required to, you're given ratios and some extract information, and you work backward to prepare the final account. I shared, there's a list of questions I answered, which I shared to you, handwritten. If you look at that list, one of the questions answered is on ratio analysis. Some questions that I shared, some solutions, handwritten, where you're given ratios and you work backward to prepare the accounts from where they are prepared. Yeah, so please, as you go through that, also check on those nature of questions where you're given some extract information and you need to work backward to prepare the income statement or to prepare a statement of financial position from where those ratios were worked out. So with that information, I want to adjourn this meeting. So tomorrow you'll meet Mwalimu. I will meet you on Saturday morning to go through the percentage of sales method of forecasting. And with that, I think this winds up. I want a volunteer to do a small prayer for us, and we wind up our meeting. Any volunteer to do a small prayer for me and for the class? Any volunteer? Is Jonas around? He told me he lost his phone. Nani anataka kutuombea sasa? Tumalize mkutano. Ala, kuna mtu anataka kutuombea surely? Regina Mudeo, can you pray for us, please? Regina Mudeo. Can you put us in prayer? Huh? Kuna mtu anataka kutuombea? Oh, Regina Mudeo, you want to pray for us?
Okay.
Yes, you can pray.
Okay, let's pray. Dear God, we thank you for the gift of life and for the fact that you brought us. And we pray that you'll help us through as we also prepare for these exams, that we all may be well. Also pray for our lecturer and for his health too. And just, okay. And it is in Jesus' name that I pray, amen.
Amen. Thank you, Regina, for prayer.
Okay, I'm sorry for stammering.
No, it is successful. The message has passed. What is important is that. So, kindly, let me stop there. I want to request you to look at your past paper and answer questions on ratio analysis. If there is any issue, feel free to ask. Okay? Once you're done with percentage of sales method, okay, will be done. I hope you guys are also reading on financial institutions. Please read on financial institutions and markets and read on Islamic finance. I gave you some handouts. So kindly invest your time and read through on financial institutions and markets, Islamic finance too. Hizo mtajisomea. Mimi nikimaliza hii forecasting, nitakuwa nimemaliza hii syllabus. Issues you want me to address, I'll address before you face exams.
Yes.
So unless there is any pressing issue, please allow me to wind up this meeting.